Hey everyone, welcome back to Corporate Decoder. Today, AMASS BRANDS Inc. just filed an 8K reporting unregistered sales of equity securities, and I am seeing a key detail about future dilution. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just sold more stock, and the price at which it can convert into common stock has some interesting features. So AMASS BRANDS Incorporated, or AMASS as it is known on the NASDAQ, has been busy. They are a company in the consumer defensive sector, specifically wineries and distilleries, with a market cap around $61 million and only 25 employees. They recently completed the second closing on a securities purchase agreement with Streeterville Capital, LLC. This is essentially a deal where the company sells stock, or in this case, preferred stock, to an investor. This latest closing happened on May 20th, 2026. It is part of a larger deal that was initially agreed upon back in March and amended in April. The important part here is that AMASS issued 7,000 shares of Series C convertible preferred stock to the investor. They received almost $7 million for this, after some transaction fees. Now, this sale was done under a specific exemption from having to register all the details with the SEC. This usually means the investor is considered sophisticated and capable of assessing the risks, and the company wants to move quickly. Essentially, they are saying this is not a public offering to everyone. The really interesting part is that this preferred stock can be converted into regular common stock. This is where potential future dilution for existing shareholders comes into play. The terms for this conversion are laid out in a document called the Certificate of Designation. Each preferred share has a stated value, and the conversion price into common stock has some flexible elements. So each of these preferred shares is valued at almost $1,100. But how many common shares do they get when they convert? That depends on a few things. Initially, it is set at a fixed price. But after certain events like 6 months post a listing date, or if something called a trigger event or event of default happens, the conversion price can become the lesser of that fixed price or whatever the common stock is trading at in the market. This is a pretty common structure in these types of financing deals. It is designed to protect the investor somewhat, but also can lead to significant dilution for common shareholders if the stock price doesn't perform well. The key here is that the conversion price can adjust based on market price, but there is a floor, meaning it will not convert at a price below a certain level. This helps ensure that the investor can at least recoup a minimum value. There are also limits on how much stock an investor can own at any one time, set at 9.99%, and also limits related to NASDAQ rules about how much stock can be issued without shareholder approval. These are standard safeguards to prevent one investor from taking over the company or causing too much immediate dilution without regulatory oversight. Looking at this filing, it's clear that AMASS Brands is raising capital through preferred stock, which is a way to get money now without having to sell common stock at what they might consider a depressed price. However, the convertible nature of this preferred stock is a direct route to future dilution for existing shareholders. The fact that the conversion price can adjust to the market price combined with a floor means that if the stock price stays low, a large number of common shares could eventually be issued. This is a strategy that many smaller companies use to fuel growth, but it always comes with the risk of diluting the ownership stake of current investors. A comparable situation to watch would be companies that have historically relied heavily on such convertible notes or preferred stock, which often see their share count balloon over time, impacting earnings per share and market valuation. What I'm actually looking for is how the company plans to use this capital to drive revenue growth and profit, which is the only way to offset the dilution that this preferred stock will inevitably cause. If the company can execute its strategy effectively and increase its market value, the dilution might be a worthwhile trade-off. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. See you next time.